So hello, everyone. I think it's about time to get started here. So welcome to another installment of the International Macro History Online Seminar Series. Very happy to have Professor Eric Monet and co-authors presenting today. The title of the talk will be The Real Effects of Bank Runs, Evidence from France in the Great Depression, 1930 to 1931. Before we begin, just let me remind everyone of the rules of engagement. So attendees are asked to pose their questions in the Q&A box. If you have a clarification, please let us know by typing in #clarification. This will be the only reason we'll stop the speaker for the first 40 minutes. After 40 minutes, we will open it up to questions, and I'll take the questions from the Q&A box in the order I feel most appropriate. And with that, I would like to get started. So we'll do 40 minutes and then 20 minutes of Q&A, and then we'll have an extra 15-minute session afterwards. If you want to hang around, it'll be a little more informal. So with that, thank you very much, Eric, for coming today, and look forward to your presentation. Thanks a lot.
So here we go. So thank you very much to all of you, to the organizers and the attendants. I'm really happy to be here and to present this research conducted with Angelo and Stefano, which is part of a broader research agenda on the Great Depression and especially the banking crisis in France. So this paper is quite, the objective of the paper are quite simple. We just are going to trying to explain the causes of the bank runs. So why did bank runs occur more in some areas than in others? And then to use this to investigate then the effect of these bank runs on the real economy, meaning the local incomes, local GDP across France during the 2 years where France suffers from the most important banking crisis in all its history, in 1930 and 1931, at the onset of the Great Depression. So my two co-authors, Angelo and Stefano, are also here, and I'm sure they will be happy to jump in the discussions after this presentation. So economists are quite fascinated by bank runs, especially because in theory, bank runs have this interesting property that they can arise as a sunspot equilibrium. So actually, just as a shift in expectations, quite unrelated from the characteristics of banks. And from this perspective, as written in the seminal paper by Diamond and Dybvig, bank runs in the models can cause real economic damage rather than simply reflecting other problems. So the Diamond and Dybvig view is quite extreme, as you know, and there have been a lot of work, and especially in theory, a lot of theoretical models to build more complex stories where bank runs are not only a shift in expectations, but also driven by the fundamental characteristics of the banks or by some kind of noisy information on the banks or on the economy that depositors may receive. But even in this series of more complex models, there's still a room for the panic, for banking panics that have a real effect, an effect on the economy, which is not fully driven by the problems of the banks. So this is not only important for theory, but obviously a key questions for banking macroeconomic history and policy. And all economic historians know how these waves of bank runs were key events during the Great Depressions in actually most countries. But there's a lot of problems to identify the real effect of bank runs, for at least two reasons. The first reason is very well known to economic historians and is directly related to the argument I mentioned before, but actually bank runs occurs not only because of the undetermined shift in expectations, but also because they could reflect the real problems of some banks, and it give rise to first causality issue, which have been widely documented and discussed in many economic history work. The second reason, which is a little less discussed, is that what is very important from an econometric point of view, if you want to identify the effect of bank runs, is that you need to care the alternative of sources of funding for firms or households. because otherwise what you measure is not so much the intensity of the bank runs themselves, but the ability of corporations to get access to other sources of funding rather than banking credits. So these two issues are very important from an empirical point of view, and they are so important that actually the large literature on bank runs, both historical bank runs and those that are occurred more recently, usually do not manage to identify this their real effect on the economy. So there is a first trend of literature that focuses on the mechanics of bank runs. So what kind of depositors are likely to run, what are their profiles and so on. So it's been done both on historical in historical research, and more recently, and there's all this literature is surveyed by the series of papers by Ayer and other co-authors. But none of these papers could really look at the real impact, the causal impact of bank runs. And there is this second strand of literature that is also very well known to economic historians, because it's been applied a lot to the Great Depression, especially in the US in the 1930s, that measures the effect of banking failures on the local economy. But usually this literature is not able to isolate the effect of bank runs per se. It's a literature that can measure the large effect of general credit disruption and disruption in financial intermediation, but not really the precise, well-identified effects of bank runs. And to our knowledge, I think the paper that really managed to identify, the only paper that really could look at the precise effect of some bank runs, was this quite recent paper by Friedman, Hilt, and Zhu, published in the Journal of Political Economy, where they look at the effect of runs on New York City Trust in 1907. And they distinguish between the corporations which received credit from some of these trusts on which there were runs, and the other corporations, and the fact that the corporations affiliated with the worst affected trust invested less in the years following the panic. So we really follow the spirit of this paper, but this paper was still on, not so much on the massive bank run that we are familiar with when we study the Great Depression. It's very local run on financial trusts rather than banks. And so what we do in this paper is really looking at this kind of the one you have in mind when we talk about really the bank run, so meaning the depositors massively withdrawing the deposits from banks. And this happened in France in 1930, 1931, like in most countries in North America, in the US, or in Europe during this period. And what we claim is very original in this paper is that thanks to a key feature of the interwar banking system in France, we claim that we can identify an exogenous shift in the probability of bank run across the country. And this is due to the fact that depositors have a very different access to safe alternative to banks. And the way they could access this safe alternative to banks is going to affect the probability of the bank run during the crisis. And as we will show and discuss a lot during the presentation and what documented in the paper, this access was quite randomly distributed across the country. So this is based on a very simple theoretical idea, which is on the fact that depositors just make a choice between the bank deposits and the deposits that can have in other institutions. So this is not something which is in the Diamond-Debye models, because in Diamond and Debye models, there's no discussion of where depositors are going to put their money once they withdraw the deposit from banks. You need to look at other models for that. And there was one earlier model by Gary Gorton, which of that was they just modeled the fact that depositors are going to arbitrate between bank deposits and cash. And so we follow this kind of intuition, and with the fact that, based on the fact that these alternatives are going to matter a lot for the probability of the rent. So what were the safe alternatives to banks in interwar France? So they were a specific type of saving institutions. So I will go back to that, but not all saving institutions, called the Caisse d'épargne ordinaire, that I will now call them the CEO. So these CEOs, they could collect deposits that were very safe and very liquid. And so as liquid as bank deposits, they paid a higher interest rate. And there was much safer. So the whole identification in this paper will rely on some very specific characteristics of the French interwar banking systems. And I'm going to describe them now because they are really key to the story here. So first, banks were not regulated. So the first franc banking laws in France were passed in 1941 during the World War II. So it was common in Europe to have no banking regulation before the 1930s or 40s. And so there were, on the contrary, there was these saving institutions that were regulated by the states. The second fact is that one type of the saving institution, the CEOs, were established across France in the 19th century. And in a way, driven by some kind of a cultural, even some kind of religious characteristics at the local level, which are really unrelated to the economic and banking characteristics, especially the one of interwar France. So in the paper, we put a lot of evidence to show that there was, before the crisis, no link between GDP growth or banking growth and the establishment of this saving institution. So it's really something that matters only during the crisis. The third characteristic, which is very important here, is that these saving institutions, they were not lending to local firms. By law, and this is the reason why they were regulated and safe, they could only invest in government debt, in public debt. So it means that when depositors are going to withdraw from banks and put their deposits in the CEOs during the crisis, the CEOs could not replace the banks and lend to the local economy. So you have really a disruption of credit at the local level, which in no way could be compensated by these other institutions, the saving institutions. And a last characteristic, which is also important because it makes the links between withdrawal of deposits and banking activity much more direct, is the fact that there was basically no interbank market in France at the national level during this period. So there was a money market in Paris for the bigger bank, but for most banks across the country, they did not usually borrow from other banks, and they did not have correspondent accounts in other banks. So when we look at the withdrawal of deposit by the depositors, we really can measure the direct impact on the bank, and do not care to pay attention from the whole possible interbank market or system of cross deposits between banks. So using this identification will be quite very important, and we will use the pre-crisis density of the saving institutions account. So we will simply use the number of accounts per capita at the local level as an instrumental variable, and we will instrument the growth rate of bank branches, which will be our only possible measure for banking activity at the local level. And through that, we will measure the impact of the growth rate of bank branches on local GDP. And so through this identification, we are able to estimate the impact of the bank rent, of the banking activity on the real GDP. So we do that by having data at the department level. So this is an administrative division of France. So we get data for 85 departments and annual data. And we've got new data on bank branches, on GDP, on many financial controls. So this paper was actually the fruit of a very long research where we collected basically all kind of financial and economic data that could be collected at the local departmental level for France. And we find a very strong effect of this banking crisis in the 3 years where banks were affected by the bank runs in 1930, 1931, and 1932, because 1932 is the year just after the second wave of bank runs, but where banks were still affected. And we find on average that 1% decrease in bank branches reduced in local income by 1%. And this is not only a strong effect, but if you do a simple back of the envelope calculations, and you believe in this causal estimate, you will find that about 1/3 of total income losses during these 3 years can be explained and driven by bank runs. So this research has consequences for obviously the history of the Great Depression and more generally the history of bank runs, but we can also discuss some interesting implications for even current policy issues, because so it's not only about the total aggregate consequences of bank runs. What is also interesting in this paper, I think, is the identification that we can rely on, which is the fact that these safe deposits are going to attract banking deposits during the crisis. And if you follow the based on the central bank digital currency, this is really the kind of issues which have been debated. Because some people argue that if central banks are going to create a digital currency, which takes the form of deposits that also individuals can have at the central bank, this would make a risk-free kind of deposits. And some people argue that during crisis, individuals can withdraw their deposit from banks and put them at the central banks. And the fact that they're giving access to a safer kind of deposits actually could trigger bank run or worsen the intensity of bank runs during uncertain times. And our paper actually show that this can happen. This can happen, which does not mean that central banks' digital currency should not be implemented, but actually the risk of bank run is not something theoretical curiosity, but it's something that can really happen when depositors are going to make choices between different kind of deposits. Some of them are really safer because they are backed by government. So I'll discuss at the end briefly how actually even our historical study can inform these debates, because we'll show how the ceiling on the safe deposits mattered a lot during the French Great Depression. So a few important characteristics of the bank runs that hit France in 1930 and 1931. So again, much more is in the paper if you are interested, as well is in a previous paper that we published recently in the Economic History Review, where we document that there were these two waves of bank runs. So one at the end of 1930 and the second one at the end of 1931. So in both cases, although we have some limited data on banks, because banks were not regulated, so it's not always very possible to identify very precisely the day by day the chronology of the bank runs. But I think broadly we know about these two waves of runs. And also there are a lot of documentations by contemporaries in the press, also in the other archives on the central banks, on the ministries, that contemporary understood that it was a true panic, true contagion of fears, so that banks that were still in good shape were also affected by banking panics. So I put here the two citations, the two quotes, one by officials of the Bank of France and one by the Ministry of Finance, that show that contemporaries understood that actually banks, even healthy banks, were touched by these waves of banking panics. So we have enough to say that indeed these were kind of true bank runs that cannot be only explained by fundamentals and bank characteristics. And then what happens, and it's something that we documented more generally in our previous paper, is that during the crisis, so bank deposits unsurprisingly decrease a lot, but deposits in saving institutions are going to increase. So in red here, you see the total deposits. So where we had the banking deposits and the deposits in saving institutions. And in blue here, you see the bank deposits. It's really the key characteristics of the French depressions, the Great Depression. And it's not only to France, but for France it's especially striking, that depositors took their deposits in banks and they put them in safer institutions. So it have obviously massive consequences on the activity of banks, because the bank deposits plunged, bank assets also decreased, but also the number of bank branches. Because during this period, there was no any kind of regulation on bank branches in France. So there was some units, some banks with only one branch, there was some banks with many branches. So there were but all these banks, even the banks with many branches, they could close some of the branches, especially because during this period, a lot of bank branches were what was called temporary branches, meaning branches that were set up 2 or 3 days a week in markets, for example. So it was, so sometimes there was some kind of delay to close the branches, but quite generally it was not very complicated to close a branch. So that was, when you look at the total number of bank branches, it really follows the pattern of the banking assets. What is also interesting, and is very also important as a motivation for study, that this banking crisis, the effect of this banking crisis were really heterogeneous across France. If you look at this map, in white, we display the departments which suffered from the very negative growth rate of bank branches during the crisis years. And in red, actually, some departments that even experienced an increase in the bank branches. And you see that there is a lot of heterogeneity in France, something which has also been documented by historians before, but basically the north, the center of France, and the southeast were really experienced huge banking crisis, but it was not true everywhere. So there's a lot of heterogeneity to explain here. So trying to explain this heterogeneity, that's also how we turn to our main hypothesis. And this hypothesis is, as I said in the introduction, is based on a very simple theoretical idea or even an intuition, by the fact that what is going to matter for the probability of the bank run, and to explain some differences in the intensity of bank runs at the local level across departments, is the access to alternatives to bank deposits. So again, if you go back to this model by Gary Gorton, where he models the arbitrage of depositors between bank deposits and cash, you can apply that to any other kinds of bank deposits, not only of other deposits and bank deposits, so not only cash. So what matters is the difference between the risk-adjusted returns on bank deposits and on the other kind of deposits. So the returns on bank deposits will depend on the risk, and will depend on the information on the macroeconomic, on the bank characteristics, and so on. So in our view, we account for the fact that we need to control for any kind of local characteristics that will affect the probability of potential of solvency issues by a bank. But the other thing that matters is also the difference between the risk-adjusted return on bank deposits and the one on alternative to bank deposits. So this will depend on all the characteristics of this other kind of deposits, and I will go into the detail later in the next slides on what they were for saving institutions. So in a nutshell, and I think the intuition is pretty clear here, is that for a given level of information of a bank, on the bank characteristics, the probability of the run will depend on the access of depositors to this alternative. So these have only been discussed for cash before, but cash is not so interesting in this case because cash is homogeneous across the country. And so it will not make a difference in the intensity of bank runs across the country. But it's not the case for the other kind of deposits. And so now let me describe a little bit this other kind of deposits. So the savings accounts, so they were regulated by the government. They were guaranteed by the government because these saving institutions could only buy public debt. So if the government is safe, which was the case for the French government during the Great Depression, I mean, these deposits are as good as gold. So not like the unsafe banking deposits. And they were very liquid. So let me come back to that in a minute. But let me, what we are going to use here as an instrumental variable and a variable of interest is the number of accounts in the CEOs before the crisis. So before the crisis, a lot of depositors already had an account open in these other institutions. So most of them also probably have an account open in bank. And then during the crisis, they could easily shift their bank deposits to the already existing accounts. So why do we use this variable? So first, something which is important is the fact that we observe that actually during the crisis, what really increases, it's not the number of accounts, but the volume of deposits. So it's very important because here what we understand is that actually this has the same depositors, which are just shifting their bank deposits to these savings institutions deposits, and not depositors which are massively opening new accounts. So it's really this reallocation of saving is really happening at the intensive margin rather than at the extensive margin, meaning that there's not an opening of new savings account, but just people putting more money in an already existing savings account. And what really also matters is the difference between this kind of saving institutions and other kinds of saving institutions. So there were two types of saving institutions in France. These CEOs, I've already talked about them. Another kind of institutions called Caisse Nationale d'Épargne, CNE. And these other institutions, they were quite different from the first one because first, they were not heterogeneously distributed across the territory because this one were opened in all post offices. And basically almost all cities have post offices during this period. So there's no heterogeneity in the distribution of CNEs accounts. So depositors might put their money in CNEs, but it will not generate an exogenous variation in the probability of bank run. So we cannot use it as an instrumental variable. But there is also a more fundamental characteristic that actually the deposits in the CNE were not very liquid because it was very difficult to withdraw in the post office. So you could easily deposit in the post office, but to withdraw back from the post office, you have to open a special account. And we observe that only 15% of the depositors actually had opened these special accounts because there was a lot of transaction cost. So contrary to the CEOs, the CNEs did not have very fully liquid deposits. And then the third interesting reason is that the interest rates paid on the CEOs deposits were higher than the one in CNE. So this is the reason why we are going really to focus our attentions on these deposits in the CEOs. So since I'm running a little bit late, I'm going to skip this slide where in this slide we were only documenting the fact that it's really the volume of deposits and not so much the number of accounts that increased during the crisis. So then some things to know before is the difference between the interest rates in these savings accounts and the one on the bank deposits. So since they were regulated, so not only the state regulated the whole framework and of the saving institution, but they also regulated the ceilings on the deposit account in these saving institutions, but also the interest rates. And they said, for reasons we can discuss in the Q&A, it's a long history, but the interest rate on the CEO was higher than the one in the other saving institutions, and they were definitely higher than the one in a bank on the bank deposits. And for also interesting reasons, basically the bank, it would not have been possible for them to increase their deposit rate above the discount rate of the central bank, which is here in yellow on the graph. So really there was a spread which was huge during the crisis so before the crisis, it started in early 1930, before the rate on bank deposits and the interest rates on other type on this safe deposit. So you see that as soon as there is uncertainty on the system about banks, for depositors, it's really beneficial to put their money in these CEOs accounts because they are as liquid as banks, and also they pay a higher interest rate. The only thing that they were not doing is they were not lending. So this is the reason why in normal times some depositors will still prefer banks, and also because there was no payment services in CEOs. But in uncertain times, when the banking crisis starts to hit, it's easily to understand why they would shift their deposits to the CEOs. So our main hypothesis really that during the crisis, there will be these negative correlations between the evolution of bank activity that we measured through the number of bank branches and this pre-crisis density of the saving institutions accounts. And this is what you can see in this graph, meaning that in departments with a higher density, pre-crisis density of saving institutions accounts, of CEOs accounts, you see that the rate of growth of bank branches is more negative during the crisis. So this is a graph where the growth rate of bank branches here is measured from 1929 to 1932, so really during the years of the most intense bank runs. But if you look at these correlations before the crisis, you don't see any relationship at all. So before the crisis, there was no relationship between the growth rate of banking activity and the density of these savings accounts. And we provide a lot more of a robustness check on the trends and so on in the paper. And the main reason why, and it's also something we document a lot in the paper, is that these CEOs, they were established in the 19th century for reasons which are difficult to relate in any way to the economic characteristics of these departments. So now to conduct our full study of the impact on real economy of these bank runs on the real economy, we also had to construct GDP data by department. So I will be very brief on that. I'm really late, but happy to come back to that and to this method in the Q&A session. So basically, we use tax revenues. So there was a special tax implemented after the First World War, which has a very wide tax base. So using this information, I think we can reconstruct quite comprehensively the total activity at the department level. And by chance, I mean, some previous economic historians have calculated very rigorously the GDP for all French departments only in 1 year, in 1930, and do that with a different method, looking at trying to reconstruct the value added for each sector. So they did that only in 1 year. So we can check in 1 year that actually our method is performing well to track the GDP. So you see here that it's very correlated to their measure of GDP in 1930. So the only year for which they measured local GDP during the interwar period. So I think now you understood pretty well our identification and the way we are going to measure the impact of bank runs on the real economy. So we use the pre-crisis density of savings account of CEO as an instrumental variables. We instrument, so this is the first stage, we instrument delta B, which is a growth rate of bank branches, which is only measure of bank activity that we have at the local level. And then we see the impact on the growth rate of real GDP. And we will add a lot of tons of controls that we also collected a lot of data on other institutions at the local level, the sectoral compositions, and also any kind of variables that could have affected the establishment of the CEOs in the 19th century, like the share of Protestants, because it was really linked to the Protestant cycles, social cycles, and urbanization rate. So we have many ways to estimate this system of equations. We could do that in a panel, but the problem with the panel is that we keep fixed or instrumental variable, so it will be like quite a false panel. So what we do instead is just like using the cross section for each year. We use as a growth rate. So I will show you graph with yearly estimations. And then at the end, what we actually prefer is to calculate growth rates over 2 years, because we have this we have two issues. The first one is that the effect of the banking crisis could straddle over 2 years, and the second issue is that actually even if the bank runs are happening in a given month, the closure of the bank branches could be delayed a little bit 2 or 3 months, which would mean that we actually observe the effect of the bank run on the next year. So that's why we prefer to use this kind of rolling window in the estimations. But basically, whatever method we use, we find the same kind of coefficients and we reach the same conclusion. So a simple graph to show first is to check that our instrumental variable is only valid for the years during the crisis. So you see here that we observe these negative correlations only for 1930, 1931, and 1932, meaning the years of the crisis. So you will say that bank runs did not occur in 1932, but as I said previously, we think that in the way that we measure bank branches, actually we still capture the effect of the 1931 bank runs on the evolution of bank branches in 1932. So this is a simple check to show that our instrumental variable is valid, because so it's significant and strong. We can also show the F-test that is a strong instrumental variables. But what is more important is that indeed it's only valid during the years of the crisis. And then this is the estimated coefficient year by year for the second stage, so meaning the relationship between the growth rate of bank branches and the growth rate of GDP during the 3 years of crisis. So the problem here is that the years 1931 is absorbing these 2 years of crisis. So this is why in the second set of regressions, actually we group these several years by using rolling windows of growth rate over 2 years, and this is the result that you can show here. So first we have this 2 year growth rate from 1929 to 1931, and you see that when we put all the controls, we reach a coefficient for the second stage of 0.8 here, and it's a little bit higher during the second period. So on average, it's just one. It's almost one for one, meaning that an increase in 1% or a decrease of 1% in bank branches is associated with a decrease in local GDP by 1%. So in the paper, we perform a lot of other robustness checks and changing in the main specification. So again, since I'm a little bit late, I'm going only to mention probably 2. So the first one is that in the estimation I've shown you, we used the pre-crisis density in 1924. So we choose this year because it was sufficiently after the troubles of the First World War and sufficiently before the crisis. But if we use any other year, we find the same results. And even actually when we use the pre-crisis density, actually back to the middle of the 19th century, where the CEOs were established, which is simply an evidence that actually there was a lot of past dependency in the establishment of these CEOs, and make the point that we can really use that as an instrumental variable. Another interesting result is the fact that if we look at the other kind of saving institutions, the CENIs, as I said before, we did not expect to find an effect because they were not heterogeneously distributed across the country. And indeed, that's what we find. We did not find a significant coefficient for the other type of saving institutions, which confirm what we knew from this institutional analysis of these different types of saving institutions. And another interesting, maybe different specification is to exclude banks that failed, because not all the banks that decreased their bank branches eventually failed. I mean, some actually, when the bank run eventually stopped, and some of them were still surviving. And so we can exclude these banks that failed. And in that case, we more precisely estimate really the impact of bank runs, and we just throw out other kind of effects that could be associated with bank failures. So in that, we find a slightly lower coefficient, so 3/4 of the total magnitude of our benchmark coefficients, but we still find an effect. So in conclusion, so these studies have have shown that we can measure and estimate the real effect of bank runs. So we can find a way to identify this effect of bank runs beyond the fact that bank runs may reflect the problems of some banks or macroeconomic regions. So, and then we find that they did play a key role in the French Great Depression. So the state clearly did not play a role of last resort, nor the central banks, neither the government, because, for example, the government could have simply re-inject the funds collected by the CEOs, and this is not what they did. So this research is more generally linked to I think what can be seen as a kind of new research agenda on the studies on the Great Depressions in different countries, that now researchers are paying more attention to the fact that during this Great Depression, there was not only like massive failures and uncertainty everywhere, but also there was some safety. So some institutions really play a key role as attracting and producing a safe asset, and so producing a safe haven for depositors, both households and firms. So something we also highlighted in other works, and in some ways it was also related to what Chris Mitchell and Gary Richardson did for the US, where so it's very different setting, but what they show is that some banks, due to this interbank network, some banks at the end of the chain play this role of producing a safe assets. And so one of the maybe conclusions that we can draw from this research for current discussions, policy discussions, is the one on central bank digital currency, because if central bank digital currency are producing safe accounts for depositors, that could be safer than bank deposits. Indeed, as some people have highlighted, they may create some of this financial instability. So our proposal here is simply to do what the French did not do in 1931, meaning that apply the ceiling on these accounts. So there were the ceilings for CEOs, but actually in the middle of the crisis, the French Parliament decided to increase the ceilings because they thought it was good for depositors to put their money in safe accounts, but it only worsened the banking crisis. Thank you. Sorry for being late. 3 minutes.
It wasn't too bad. Thank you, Eric, for that very insightful talk. And I just want to say congratulations. It's an amazing project with so much to think about, so much great data, and the conclusions leave a lot of things to think about and are really helpful for the literature. So that's fantastic. There's a little bit of a deficit of questions in the Q&A room. I'll wait for a few more questions to come in, and as is customary, I'll abuse my privilege as chair. So I think this is really interesting, and one thing in the back of my mind is about your key right-hand side variable, which is branch failures. And you very much want to talk about bank runs. I think I'm willing to, conceptualize a branch closure as a bank run for the moment. But I have a hard time, and maybe it's just me, thinking about what a branch closure is. If I think of bank failure, that's more obvious to me, but a branch closure could be a lot of things. So maybe you could help us out a little bit by discussing what a branch failure actually means. And I also, which is a little more second order, I had a hard time thinking about what a 1% decline in branches in a locality means. I think I would prefer like a whole number, an integer number, over a percentage, but maybe you can do the translation on the fly here and help us think about that.
Thank you very much. So can I start? I can start giving you a short answer, and if my co-authors want to jump in. So regarding the closure of bank branches, so it was not so. I mean, closing the branch of a bank was not so difficult. I mean, just like these banks had multiple branches, Some have a nationwide network of branches. Some have branches only in one department. So there were very different kind of banks. So obviously, the most obvious case, the one you mentioned, is a case of bank failure. So in that case, there is clearly the bank just closes and the branches no longer exist. And then there are these other cases when the branch is closed. So it will depend a lot on the type of branch. I said before that 25% of the branches were temporary branches. So what were called temporary branches is that branches that did not, exist physically like a building, and they were not open every day, but they took place simply in markets. So usually 2 or 3 days a week. So there was someone from the banks going to this market and collect deposits, giving advice or performing the standard banking activity. So this is a most obvious case to close a branch, because in that case you just don't go to the market because you think that the client are either going to withdraw the deposits or just there will be no activity. So then the other case is a case where the branch existed physically and was open every day. And again, what we observe is that these banks closed a lot of these branches. So we think that is directly correlated to the ability of the bank to collect deposits or to lend credit. So maybe some of my but and your second remark is sweet. Something we want to do for a long time. It just like calculate the equivalent for it's not difficult to do. We just have to do that. But it's true that we can easily do that, linking that to credit or branches. I don't know if Stefano or Angelo want to jump in.
Let's say very quickly. Unfortunately, it's the only measure of banking activity we have at department level, because we have no statistic of deposits and so forth at department level for banks. But the number of branches is very well correlated with at the national level with a measure of banking activities at national level that we compute from the balance sheet, like total asset, credit, deposit. So I think it's a quite good proxy for the banking activity at local level.
Yeah, definitely. It's sorry if it was not clear, but it's true that otherwise we will use the bank assets and so on. But it's we have the information on bank assets only at the national level, and it's consolidated over all the branches across the country. So we cannot use any balance sheet information at the local level. So that's why we use this measure.
Okay, excellent, very insightful. So Killian Reader has a question in the Q&A. I'd like to unmute Killian if he's okay with that. So I'll do that.
I just wondered more generally if you could talk a little bit more about the policy context, the policy response by the central bank, because I mean, you mentioned it now in the conclusion, but you haven't said a lot about that during the rest of the talk. And I wondered whether, the Banque de France, how it reacted to the crisis, what it did about the bank runs, if anything. And basically the question comes up because I, remember this other research that is out there on earlier crises where the central bank does really a lot in terms of regional lending through its branches. And so, yeah, generally I wondered how that fits with your story and whether you, what your response is on that. Thanks.
Yes, so thank you very much for this question. So the very brief answer will be to say that there was no reaction of the central bank, like in the US or in the other countries. The central banks did not provided liquidity to stop the crisis. Only 2 banks were saved by the government. So it was not enough to avoid this big fall in banking activity, in bank deposits and bank branches. So then Chris Mechner and I are currently working on the reaction of the Bank of France during the crisis. So there will be a lot of things to do about why they did not react and so on. But I don't think it's linked to this identification that we're making at the local level, because we don't observe at all any difference in the reaction at the local level. So it's true that the Bank of France itself had branches across the country. There was some kind of a margin of maneuver, so some kind of flexibility in the way these branches could apply collateral rule in lending. But for everything, from everything which have been shown for the Bank of France during this period, there was no big difference in these lending policies of different branches that could create an exogenous variation during the crisis. So it's not, I've looked for that, but there's no case like the one famously studied in the US between this, I think Atlanta Fed, or where we show that one central bank's, one local regional central bank expanded credit while the neighboring central banks did not. So we really don't observe that during this period.
If I can add just a couple of words to explain the difference between the studies you was quoting. Vincent and his co-authors were studying the 19th century, where the Bank of France has a policy of support of regional local banking against the big national banks. In the 19th century, in the interwar period, as many historians like Lescure and Plessis showed, the Banque de France, to increase its own business, doesn't support anymore the regional and local banks against the big national banks. So basically, that's the explanation of the difference between the 19 and the interwar period. But anyway, because the Bank of France is a very hierarchical organization, there are not differences on the territory in its policy, let's say. It's not like in the US, as Eric said. So it's quite homogeneous over France.
In the chat, question by Sarah Quincy.
Yeah, there's a question by Sarah Quincy, and I've unmuted her so she can go ahead.
Yeah, hi. So this is really cool. I'm just kind of curious, given kind of based on what Chris said, thinking a little bit more about sort of branch closures reflecting local deposit demand versus bank level competition for two reasons. One, just sort of on its own, it's an interesting channel. And then two, given that you're talking about two different kinds of institutions, it seems like, at least I'm still trying to understand sort of the specialization and kinds of lending they're doing, which could explain sort of how these real effects are coming about.
Yes, so you if I understood well, your last remark, you were wondering about the kind of credit that these specialized saving institutions could do, or because the saving institutions, they were not lending, which is very important for our story. Meaning that, and I know it's different in other countries. In other countries, the saving institutions, they could, somehow replace bank and lend at the local level, which was not the case in France, because by law, these saving institutions, they had to invest 100% of their assets in government debt. So they could not replace banks at the local level in lending to firms. So what we are capturing is not a reallocation of lending between the banks and the other type of institutions. It's not all that. And this is very important, because really, when this happens, it means that the potential other effect of lending at the level is completely cut by this, because there was no program. There could have been a state program, to reallocate this kind of savings to the local economy as a share of the intensity of the bank run, for example, but it did not happen. It did not happen this way. And the other way I understood your question about this bank competition could be whether actually the decrease in bank branches, it's not only a sign of a decrease in bank deposits and in bank lending, but it's also a change in banking competition at the local level. And it's really actually it's something we looked at the beginning of a study, but it's really not working like that, because when branches are decreasing in a department, they're really decreasing for any kind of banks, whether we talk about big national banks, which are branches all across the country, or unit banks. So actually, at the beginning, we look at this at the share of different types of banks at the local level, but I think we actually do not even report these results in the current version of the paper, because it's but maybe we should actually emphasize that on the fact that there are no effect at all on banking competition. Thanks for this question. I think it's
we have a question from Joachim Book in the Q&A box. I will unmute you if you want to go ahead after that.
Yes, sure. So I'm sure I'm missing something basic here, but I'm still on the insolvency versus real economic effects, sort of, or insolvency and illiquidity problem. You observe a run into a safe asset that cannot be recycled back into the economy, and you observe number of branches on the department level. But how does that allow you to conclude that the run into the safe asset is not reflecting the underlying insolvency issues? Am I missing something very fundamental here?
Sorry, I really couldn't hear very well your question, so I'm going to respond to what you wrote in the in the chat. But so you said how can we share that what we measure is not something reflecting the of the banks or the insolvency issues of the banks. So here, our assumption is the fact that for controlling for local characteristics, actually all banks were hit by the same contagion of fear at the macroeconomic level. So there is big uncertainty nationally. So for different reasons, I mean, a little bit long here, but in 1930, it's coming from the stock market. In 1931, it's coming from Eastern European crisis. So even if actually the banks were never really exposed to the stock market, only some of them were, not the majority of the banks, and the banks were not exposed to the Eastern European crisis. But actually, there is a contagion of fear across all countries. So the depositors withdraw from these banks. We control from all kind of macroeconomic characteristics at the local level. And what we say that we just want to capture one reason, and it's not we're not explaining the whole bank run. We just want to capture one exogenous variations in the probability of bank runs across regions. And this is coming from the fact that depositors have different access to safe alternatives in different departments, in different regions. I don't know if it's clear.
So we're getting very close to the end of our allotted hour. So, but we do have an extra informal 15 minutes. So at this point, let's take a pause and thank the speaker and his co-authors for presenting a fabulous study of Great Depression in France. And before everyone else leaves, I just want to give you a little shout out about the next seminar. A week from today, we'll have a seminar, same place, same time, Banking Crises Interventions, the year 1290 to 2018 by Andrew Metrick and Paul Schmelzing. So stay tuned for that. And if the co-authors and any audience members want to hang around for an extra 15 minutes and carry on the discussion, we'll be here. Thank you again. I think we can restart. People are leaving. Some people are still around. I didn't mean to cut you off, but I didn't want to go over the hour.
Yeah, sure. It's totally fine. No, I was taking note of the paper mentioned by Sarah, because I didn't know. this paper. I think maybe we should talk more about this. I see that Maëlys also responded to that Maëlys, I don't know if you're still here, Maëlys, but you don't observe differences across types of banks or even regions.
If I remember well, the paper used 1898 data, so it's focused on 1 year, and it's not contradictory. It depends a lot on the appreciation that the solvability of the bank by the Bank of France. Clearly, if Le Crédit Lyonnais in Bordeaux is in trouble for some reason, maybe the Bank of France can enlarge the discount window also for the branch of the Crédit Lyonnais in Bordeaux. But yes, it's an homogeneous policy.
Maybe also to reply to this question by Kylian, maybe it's something we should emphasize more, is that there's never been bank runs in France before. I mean, there have never nationwide bank runs. So it's not something like the central bank had ways to respond to that or knew how to respond to that. So it's very different from the kind of normal policies that they will apply to respond to seasonal credit fluctuations, or even some fluctuations in credit due to adverse shocks like the one that we described in the paper by Maëlys.
Can I ask a question or two? So first of all, I really like the paper, the data and the results. I think there's nothing to take from there, but I have a couple of nerdy questions, and they have to do with the specifications. So I know that the very end of the paper, you discussed the validity of the instrument, but I'm still a bit confused about the exclusion restriction. So you address this by looking at whether you can predict where the CEO branches would be located. Of course, you use past data and so on, but you sort of want to put the case that they were more or less, they were not randomly assigned, but the assignment was orthogonal to the consequences of the crisis. Fine, but why would that be the case? And actually, the discussion we had with Chris and Sarah point to a possible contamination mechanism, which would be the effect of local banking competition, right? So the presence of a CEO branch or a denser CEO branch would affect the local competitive environment, which could then affect the financial situation of the banks at the time of the shock, right? So this could be a violation of the exclusion restriction. The other thing I noticed in your table is that your results increase in size as you add controls. This is strange, right? And all else equal would point to a problem of bad controls. And in particular, looking at when you included, so the lending activity and the interest rates of the Crédit Agricole and the Crédit Foncier, again, it's hard to believe that those wouldn't be jointly determined with the change in the size of the commercial banking sector, right? The change in branches, and also the presence of other caisse d'épargne. So those were my questions. So they're nerdy. I like it.
That's very important, and I think we wrote a very two lines in the paper about that, and that might not be enough. So the reason why, and we ask ourselves these questions, why the results were the coefficient was higher when we introduced controls. And this is largely due to one control, which is what we call the banking development before crisis, which is just simply the total number of bank branches over GDP before the crisis. And actually what happened is that the departments which were more affected by the crisis were the one with higher density of banks before the crisis. And actually there is a correlation. The only positive correlation that we find between the density of saving institutions and other kind of characteristics before the crisis is a positive correlations between the saving institutions and banks. So it means that actually the departments which had more saving institutions were also the departments which had more banks. So you have actually a positive correlation between the two before the crisis, which is going against your first hypothesis that there will be some kind of competition before the crisis. And it's something that is quite striking, but it's been also documented by the historians who did wrote the history of this institution, that they were not really competing with banks at the local level. It was more a complementarity than substitutions, especially because they were not lending at all.
Can I add to that?
If you want, sorry, please.
Follow up on Rui's question and maybe add another more general question. So following up on this exclusion restriction, so let's go through the following scenario. So for whatever reason, there are these banks, the CEOs in some departments, and there's a banking competition, and the CEOs can offer a higher deposit rates because they invest, say, in government bonds or whatever. You mentioned the fact that they're offering higher deposit rates, that like these saving institutions usually have higher. So the banks at the local level, therefore, have to offer or would have to compete on clients and therefore engage in more risky investments. And those risky investments are the ones that fail and they bring about the. So it's not necessarily the bank branch closure, but the behavior of the lending banks because of competition might have created this. I mean, I don't know if this is true, but this is one channel through which this exclusion matters, I think, in the sense of the local economy. And so that's kind of one thing. And generalizing a little bit more, and it gets to your policy implications as a former central banker, this is something that I'm really interested in. So are you suggesting that safe assets create bank runs? So therefore, it may be not a good idea for central banks to offer a safer asset. This goes against, obviously, the Kumhof arguments, the Bank of England thing about sort of getting banks out of lending and whatever. So this is kind of generalization that suggests your kind of factual is that had the CEOs not existed in those departments, bank branches would not have been closed and everybody would be better off in some sense. So, I mean, just taking these policy implications a little bit further in the sense of, I mean, it's just, you know, it's not about your paper per se, but it's more about interpreting the results in some kind of general equilibrium sense. Yeah.
So let me start with your last question on relevant policy conclusion. So definitely we want to emphasize that there is a risk, the fact that when the government creates a safe asset, this creating a safe asset can trigger some reallocation of funds towards the safe assets, and it's especially true during times of uncertain time, which does not involve at all that we are against government interventions or we are against central bank digital currency. On the contrary, I think, and it's the same with the saving institutions. I mean, these saving institutions, they played a very important role in France for what we call now financial inclusion. I mean, it's true that a lot of people will not ever have access to thrift without this institution. So if you measure the aggregate welfare of these institutions, I think they can still, it's definitely very positive if you look at their effect over 2 centuries. But still, it's true that during the crisis, I think there would have been a banking crisis without these institutions. I mean, clearly, there some banks were insolvent. There was some, but we also think that the fact that there were these institutions, it worsened the crisis, and something that even worsened the crisis more after the first waves of crisis. So obviously, everybody in the country had realized what was happening. So what we were showing here was known by all contemporaries. Everybody had noticed that people were taking their deposits out of the bank and putting them in these institutions. But the consequences that was drawn from that was to actually increase the sailing on these accounts, on these safe accounts, because the parliament decided that it was better for depositors to allow them to put them. So taking this decision, the parliament did not have what we would call today, and did not have a macro-prudential view, you see? And I think that is what really matters here, that we need to have this macro-prudential view where we still allow these safe accounts to exist, but we can play on some regulatory tools like ceilings on this type of accounts to avoid that this kind of safe accounts can worsen banking crisis. And if I may go back to your first question, I think that you're emphasizing an important channel. So if I understood well, you say that in department where there were more CEOs, so saving institutions before, the banks could have taken more risk to attract and so the bank would be more risky. And actually, this is what we, in some way, we control for when we control for the size of the banks, the number of bank branches in each department before. And I think this is one of the reasons why the coefficients change in this case and get higher. But we should be more explicit about this channel in the paper.
Mm-hmm. But basically, there is also a paper of Brajon and Moore where they don't find that this effect of savings institution on bank branches, indeed. On the contrary, they underscore that the saving institution could enlarge the market for commercial banks because of the effect of bancarization, financial education, and so forth. Eric was mentioning.
Yeah. Nathan, I mean, my idea was precisely along Nathan's, right? So it's not competition for loans, it's competition for funds. But even if it's a positive complementary relation, the violation of the exclusion restriction will still be there, right? So
yeah,
in this case, you would be overestimating the effect, whereas in the other one, you would be underestimating it.
Yeah, sure. So, yeah, and the question is whether controlling for what we control for is enough. I think,
or too much.
That to you. I mean,
no. Actually, I was saying it might be too much, right? We're now being asked to think more clearly about including controls, right? This literature about colliders and so on.
Mm-hmm.
So, what I was saying is that you're probably over controlling, but you identify this as down to just one of the controls, right? So maybe you can just show the results with and without that control, and just reassure the reader from that on that you're not over control. Hi, Stefano, you're there.
Yeah.
Thank you very much.
Thank you for this, Rui. This was very useful.
Thank you, guys. Thank you. All right, our chair and leader, are we okay?
Yeah, no more questions. I'm okay if you're okay. So do I need to do anything, or
you need to informally end the session so we can stop it?
Yeah, we are still recording. So yeah, thank you again to the speakers and to our hosts in Geneva, and wherever you are in the world, stay safe, and we'll see you next week.
Absolutely. Thank you.
Oh, thank you.
Thanks, everyone.
Thank you very much.
Ciao.
Have a nice day.